In this video, we're going to talk about the Greeks, which are mathematical parameters that help you better understand and manage the behavior and risk of option contracts. We're going to define the primary Greeks, delta, gamma, theta, and vega, and provide an example scenario with each parameter at play. Let's start with delta, which you can think of as a sensitivity meter. It predicts how much the price of an option might change for every $1 of movement in the price of the underlying stock. Delta ranges from -1 to +1. The closer it is to these extremes, the more sensitive the option. Next up, we have gamma. If delta is about option price sensitivity and is a point-in-time reference, gamma is about the acceleration of that sensitivity. How quickly is delta changing over time? It predicts how delta itself will change with a $1 price movement in the stock. So if you've got a delta of 0.5 and a gamma of 0.05, and the stock price goes up by $1, your new delta might increase to 0.55. Since delta cannot exceed 1 or -1, gamma usually falls the closer delta gets to its extremes. Now, let's move on to theta, the timekeeper of the group. If you've watched our video on time value, you know that as each day passes, an option loses some of its value, even if everything else remains the same. Theta tells us how much time value the option will lose daily. So, for example, if the theta of your option is -0.10, it might lose 10 cents in value every day, even if the stock price remains unchanged. Last but not least, vega tells us about the option's sensitivity to changes in implied volatility. What's implied volatility? Simply put, it's a measure that shows how much traders think a stock's price might swing in the future. Implied volatility is reflected in option prices, and higher values mean traders are expecting bigger price moves, up or down. In practical terms, if the stock is expected to become more volatile and this expectation rises, vega shows us how the option's price might change. For example, a vega of 0.20 indicates that the option's price could go up or down by 20 cents, with a 1% increase in implied volatility. Now, let's ground all these concepts with a hypothetical. Imagine you're considering a call option on a company called FlyFit that costs $10. At the moment, the option's delta is 0.6, gamma is at 0.1, theta stands at -0.05, and vega is at 0.20. Now, let's say there's a rumor that FlyFit is about to launch a new product, causing its stock price to jump by $2 and increasing its implied volatility by 2%. Here is how each Greek might potentially impact the option's price. First up, the option's delta would suggest a $1.20 increase in the option's price. How do we get that? We multiply delta by the $2 rise in stock price. So 0.6 times 2 equals $1.20. Next, gamma comes into play. Remember that gamma predicts how delta will change with a $1 price movement in the stock. In this instance, we multiply the gamma of 0.1 by the $2 price increase to discover that our delta would now become 0.8 for any subsequent stock price changes. Moving on to the 2% increase in volatility, vega tells us there would be a 40-cent change in the option's price. Again, it's because we take the vega value and multiply it by the 2% increase. Finally, theta. Regardless of these changes, our option will still lose 5 cents in value every day, thanks to time decay. So if a day passes, that's a 5-cent decrease. Putting it all together, we'd expect that the new price of the option would be about $11.55. The original value of $10, an extra $1.20 due to the stock price rise, an extra 40 cents due to a rise in implied volatility, and 5 cents less due to 1 day of time decay. By understanding and calculating these shifts, you can anticipate how various factors might influence your option's value in the market. The Greeks, delta, gamma, theta, and vega, are some of the most essential tools in an option trader's toolkit. They help paint a comprehensive picture of an option's risk and potential rewards.